What's trending in lending this week?
What's not trending
What's
in
not
lending
trending?
this week?
Everything. What is trending is loan market edge. But besides that, thought today we're really going to talk about is end of financial year. We are effectively, crazy to think, 8 weeks out from the end of another financial year.
Rolls around quick.
Which rolls around very quick. But what does that mean for you and what does that mean for lending? I think that's probably a conversation that we're having a lot at the moment. And I thought that would be a really good one to touch base on. So we have the advantage that we're this far into the financial year now. Effectively 25s are due.
That's the minimum.
Yep. That is the one we're using. 24s we can kind of leave to the side now with a lot of lenders, which is really, really helpful as businesses have grown.
Yep.
25s are on, but we're in this really great window of opportunity where 26s are starting to become a thing. So we look at cash flows, we look at projections. We're kind of far enough in now to know a 25 is going to be what helps us.
Yep.
You know, we've got lenders that, and this is the landscape, right? Every bank lends money really differently, but I think self-employed is probably the one that shifts the most out of policy. And
it's got the most nuances. There's just so much different stuff that plays in.
The whole traditional format of lending where you've got 2 years or 3 years worth of financials, etc., it's kind of gone, which is really helpful. And if we want to isolate, for example, 25s now, we have a really great window where it's 25s plus maybe 2 or now 3 BAS, you know, your most recent 2 BAS, and showing that that year's consistent, we can kind of go past any variance from 24 because we can show 25 and 26 are working. So as a self-employed client, when you're going, okay, I want to borrow money in the next 12 months, this comes down to some really good tax planning, one with your accountant, but two, before you go to your accountant, right? We've got this 8 weeks. We want to borrow money in the next 12 months. These 26s are going to be the ones we can use. 25s we can still use in isolation. That's an awesome window. But 26s, if they're the year that we want to be using, we can make sure that we really put the work in, work closely with the accountant.
I was going to say that's the important part, is the relationship with the accountant.
We know where we are. We know where we are now enough. You're 8 weeks out. We can tell how the business is going to perform, right? And we can kind of dial some things up, dial some things down, just to make sure from a lending perspective, because accounts can be prepared kind of 2 ways, right? One for the purpose of accounting, often to help you minimize tax, because it's the goal.
It's always good.
It's the goal for most people. But the other version of that is prepared for lending.
Well, they're not the same thing. They're not really. They both tick a different box. So understanding the balance between the two, and that one is potentially going to hinder the other more so. The tax side. Then obviously with the lending, it's
just the communication piece, really, isn't it? The great news is you pay no tax. The bad news is you can't borrow any money, right? So it's a little bit of a tricky one there. And working closely with your A team, having a good broker, having a good accountant, having a good financial planner, having that team around you helps us kind of build that out. And that window of opportunity we have now to look at both 25s and 26s kind of in isolation is a really sweet spot, and it's probably the conversation we're having the most with our self-employed clients right now. And that policy, even, you know, people talk about low doc and no doc, and, you know, I mean, now they'll even accept just director wages.
Yeah, you know, a lot of lenders with simple self-employed policies out there. 2 pay slips, they'll treat you like PAYG. Like there's a lot of options. I think that's probably the highlight of all this.
Which opens the doors, right? Because if you're a trades business, for example, and you've got 15 leases on the road, like that stuff's really tricky if you've got to involve all of that. Where some banks will take a more, again, the simple self-employed route, or dare I say common sense approach. Common sense isn't all that common in banking, but common sense approach to how do we help self-employed, right? And it is about not only, you know, you need a bank that knows self-employed, but more importantly, you need a broker that knows self-employed, because you could spend 4 weeks going around in circles with your bank, and it may not be that it's not that you don't qualify, it's just you don't qualify with their requirements, right? And that's where we sit back and go, well, what do we need? What are we looking at? Do we need the 2 years? Do we need simple self-employed? Can we take a year in isolation? Can we use cash flows and projections in the year that's coming, right? Every one of these are all different banks, you know, and that conversation at the moment around kind of, again, not only the accounts and getting them ready for lending, but also tax planning, starting to look a year in advance, not kind of historically, traditionally, an accountant looks historical. You go in and see them and they give you the good news on what you did 12 months ago, right? Where in the current market, especially with kind of the redlining of a lot of small businesses in the current market, small to medium-sized businesses. We actually need to know what's happening 12 months in advance. Right, we want to understand tax planning. What do I need to put aside for? And we're not accountants. This isn't tax advice. But when we're talking about these things, this is the sort of things that play such a big role in your ability to be able to borrow money.
It probably highlights the importance more than ever if you are self-employed to use a broker, I guess, in general. Because if you go just to your bank, they've only got that one policy. They're going to ask you for everything, and they're only going to work in that box. We're going to look at all of the different options and assess what we've got access to, talk with the accountant, understand kind of the greater picture before we then sort of narrow out focus in and look where we're positioned. Again, you look at the borrowing capacity variance, you'll have one bank that'll give them 100 grand and one that'll give them $1 million.
It's crazy. Just because of, we take the lower of the two. It's greater than a 20% variance, so we adopt the lower of the two, and there's no real common sense in going, but the business now has picked up 3 new contracts and 10 new staff and it's turning over $3 million more. They go, we won't take that variance, right? Which is crazy. And so it's not only, it's about asking the right questions too. Ask the broker and make sure that they're really comfortable. Like, dare I say, we love complex. I'm not sure the team will do that. But if you think about your position, you go, it's all too hard, or I don't understand it, or every time I go to the bank, it seems so difficult. Reach out. That's why you should be talking. These are the sort of things we do know and kind of love being involved in, and this is the relationship piece.
This is the exciting stuff. It's the creativity, it's the discovery, it's the curiosity of how am I going to solve this puzzle, I guess.
And we're also going to be here next week and the week after that and the year after that, where unfortunately, no disrespect to the banks, but people leave, they start, they move on, they change, and you've got to start all over again. It gets really complex.
Yes, 100%.
The other big one, rates next week. Will they move or will they won't move? Jesse, your thoughts?
It's probably not a will they or won't they. It's probably a how much, I think, at this point. Seen some recent stuff in there over the last couple of days. Obviously, the inflation for March up sort of 0.9% against February there, which is quite a sizable hit. I think the biggest highest in the last couple of years, which has kind of got a lot of people suggesting maybe a double rate hike, sort of 0.5%, which will be a really big hit.
It's the scary part, right? How high, how high and how quickly. Right. Now I don't want to blame Jesse for them going up, but I want you to know that I hope they don't.
And I want you to know that nothing he says.
No, look, it's an unfortunate part of what's coming, and so a lot of the other work we're doing for that is just around helping clients get ahead of this. Right, so if you think there's going to be some pressure, if across a portfolio or across your asset, 0.5%, if a full percent is going to make a significant difference, which it will for a lot of people, reach out early. Don't wait till it happens and then wait for 3 months and hold on and then find yourself in a position needing to do something. So let's jump onto that early. Let's have the conversations now, knowing that this is what's coming for the back half of the year, and let's get kind of prepped. We can restructure, we can kind of redesign the position and just take a little bit of pressure off what's coming. So fingers crossed though next week that my hope comes true, not Jesse's, and rates don't move, but we'll be here to talk about it next week. See you then. Sweet. Bye for now.
Thanks guys.